The stock market is not gambling. Most people think the stock market is a casino. They picture flashing charts, risky bets, and people getting rich overnight. But that's not what it is. Gambling has no productive outcome. The stock market funds real companies that create real products, hire employees, and generate profit. When you buy a stock, you are not betting red or black. You are buying ownership in a business. The confusion comes from short-term trading culture, not from investing itself. If you treat it like a casino, it will behave like one. If you treat it like ownership, it becomes wealth building. The market is not dangerous. Ignorance is. When you buy a stock, you become a business owner. When you purchase shares of a company, you legally own part of that company. That means you own a share of its earnings, a share of its growth, a share of its long-term success. If the company expands globally, increases profits, or innovates successfully, your ownership benefits. That's powerful. The problem is, most people don't think like owners. They think like traders watching price fluctuations. Owners focus on business fundamentals. Traders focus on price movement. Wealth follows ownership thinking. Stock prices move for one reason. At its core, price movement is simple: supply and demand. If more people want to buy a stock than sell it, the price rises. If more want to sell than buy, the price falls. Short term, this movement is driven by news, fear, hype, and speculation. Long term, it is driven by earnings growth, innovation, and economic expansion. In the short run, the market behaves emotionally. In the long run, it behaves rationally. Understanding that difference prevents panic. Volatility is noise. Performance is signal. The market reflects human psychology. The market is not just numbers. It is collective emotion displayed in real time. When optimism spreads, prices often rise too far. When fear spreads, prices often fall too much. This is why bubbles form. This is why crashes happen. The market tests your emotional discipline. Can you stay calm when others panic? Can you avoid chasing excitement? Mastering investing is not about mastering spreadsheets. It's about mastering yourself.
Time is the real secret. Over days or weeks, the market feels unpredictable. But zoom out over decades and you see something powerful. Despite recessions, wars, inflation, and crises, markets have historically trended upward. Why? Because businesses grow, technology improves, productivity increases, time smooths volatility. If you try to predict short-term moves, you compete with emotion. If you stay invested long-term, you align with progress. Time is not your enemy. Impatience is. Wealth in the market is not fast. Real wealth is built quietly, through consistent investing, through reinvesting dividends, through resisting emotional reactions. Compounding does not feel dramatic. It feels slow at first. But as years pass, growth accelerates. The investor who contributes steadily and reinvests earnings often outperforms the one chasing trends. Wealth is not built through excitement. It is built through repetition. Consistency beats intensity. Most investors fail for one reason. Most investors fail because they react emotionally. They buy when excitement is high. They sell when fear dominates. This behavior reverses the basic rule of investing: buy low, sell high. The market transfers money from the impatient to the disciplined. Success in investing is less about intelligence and more about behavior. Discipline during downturns creates long-term advantage. Emotion creates losses. Market crashes create millionaires. Market crashes feel catastrophic, But they also create opportunity. When strong companies temporarily decline in price, long-term investors accumulate ownership at a discount. Every major market downturn in history has eventually recovered. Crashes reset valuations. They reward patience. Volatility is not failure. It is the cost of long-term returns. Fearful investors exit. Disciplined investors build. The stock market is just a tool. The stock market is just a tool. Like any tool, it amplifies the person using it. A hammer can build a house or destroy one. The market works the same way. If you invest without a plan, without discipline, without patience, it magnifies mistakes. If you invest strategically, consistently, and long-term, it magnifies growth. The market is neutral. It does not care about fear or excitement. It rewards structure. It rewards ownership. It rewards time. Many people blame the market for losses. But the tool isn't the problem. The framework is. Used wisely, it becomes leverage. Used emotionally, it becomes expensive. The stock market is a wealth engine. It connects capital with innovation, ideas with execution, and patience with growth. It allows ordinary people to participate in extraordinary businesses. It is not a shortcut, not a lottery ticket, not a miracle. It is structured ownership in economic progress. When companies grow, expand, and generate profit, long-term owners benefit. The market rewards discipline, consistency, and time, not prediction. If you approach it emotionally, it feels volatile. If you approach it strategically, it becomes powerful. Think like an owner. Act with patience. Let compounding work. That's what the stock market really is. The market is designed to test you. Not your intelligence, your patience. It will rise when you doubt it. It will fall when you trust it. It will move in ways that challenge your confidence. Most people quit because they expect certainty. But investing was never meant to feel comfortable. The stock market rewards those who endure volatility without abandoning strategy. Short-term noise is constant. Long-term growth is earned. The investors who succeed are not the smartest. They are the most consistent. If you can stay calm when others panic, you gain an advantage most people never develop. Patience is not passive. It is strategic strength. Stop thinking like a buyer. Start thinking like an owner. Buyers focus on price. Owners focus on value. Buyers panic when prices drop. Owners ask whether the business is still strong. When you shift from watching charts to analyzing companies, everything changes. Ownership builds conviction. If the fundamentals are intact, volatility becomes opportunity. But if you only follow price movement, emotion will control your decisions. The stock market rewards ownership thinking. It punishes emotional reactions. The difference between stress and strategy is perspective. When you own productive assets long-term, you participate in growth, not speculation. That mindset is what builds durable wealth. If you want returns, you must accept volatility. There is no long-term growth without short-term movement. Prices rise, prices fall. News shifts sentiment overnight. But volatility is not failure. It is the cost of participation. Every major bull market included pullbacks. Every long-term upward trend included fear. The mistake is expecting smooth progress. The market rewards those who understand that discomfort is temporary. Volatility tests conviction. It filters out emotional investors. If the underlying businesses are strong, temporary declines are not destruction. They are fluctuation. Growth requires resilience, and resilience requires perspective. That is how long-term wealth survives turbulence.